Uh, Hello, our project is SoFi stock data trend analysis, where we took historical data from SoFi stock and performed numerical analysis methods on it to see the potential trends. So our main goal was to analyze a stock's performance over a period of time to identify the trends and patterns while simplifying the complex data. This approach should enable smoother analysis and support better predictions for informed decision making. And although hard to predict the stock market, this analysis can help investors identify significant turning points and make more accurate predictions. We used a historical data set as our data source from SoFi stock. It was about a 3 to 4 year range, and then it also gave 7 columns. So the date, the open column, the high column, or the open value, the high value, the low value, the close value, the adjusted close, and the volume. And so then we downloaded this data and stored it into a CSV file. And the column that we did the analysis on was the close column.
So for our numerical analysis method, we use linear, quadratic, and cubic least squares approximation. The reason we use linear was because it's simple. It simply just shows an upward or downward trend, and then there's like a reduced noise. Makes it pretty easy to understand. For quadratic, if we wanted a bit more complex analysis, it's good for showing turning points, so peaks and troughs, and then for like a shorter to medium forecast, if we didn't want to do like a full like 6 years or something long like that. And then finally for cubic, it's even more complex. The curve is a bit more fitted towards the data. So if there's a lot of ups and downs in the data that we have, it fits it a lot better, um, which also goes for a more exact forecast. For our implementation procedure, first thing that we did was we collected the data. So we chose SoFi as our stock, but this could be used across any stock. You just need to get the right amount of data from it, so 3 to 4 years. The model selection, so linear, quadratic, or cubic, um, whatever you're wanting to look at with the stock, that's when you would decide between the three. For fitting the model, we just use NumPy instead of Python. It helped us fit the square the best. For visualization, we're using Plotly to visualize on a graph. And then for interpretation, for linear, positive or negative slope to determine an upward or downward trend. So just pretty basic. Quadratic, the peaks and troughs again. And then for cubic, just fits that line even better than the quadratic.
Yeah, so we'll go through a bit of the implementation. So on the left here, you can see this is what the data looked like in the CSV, where we just have some ticker prices with the open, high, low, and close values for the SoFi stock. And then on the right is the script we use in Python. Like mentioned, we used NumPy and Matplotlib. And then we also use pandas for reading in the CSV. And then we perform the same polynomial fit over 4 different degrees, which are graphed in the following slides. So this is what the linear least squares approximation results looked like. So you can see it captures a little bit of the trend just to see if the stock price is basically going down or up over the course of the 1200 days that we estimated. And then you can see our mean squared error and root mean squared error, which ended up being about 3.52. So it's not a very good approximation for data. And then we get a little bit better as we move to a second degree polynomial fit. You can see we capture a little bit more of the upward trend at the end, um, but it still has root mean squared error of 2.35, so it's about one better than the root mean squared error of the linear. And then moving on to quadratic, we again, or sorry, cubic, we get a little bit better. We see not only a little bit of the upward tick towards the end, but we also get a little bit of a downward trend. But you can see that none of them are actually picking up this this extremely variable portion towards the beginning of the data, because they simply aren't a high enough degree polynomial in order to catch these kind of really sporadic changes in the price of the stock so far. And then for a little bit of a demonstration of like what overfitting looks like, we decided to include a 10th degree polynomial. And so here you can see it actually does pick up on some of this like sporadic changes in the price or in the price of the stock. But as you'll see in the next slide, it's not actually a great idea to use polynomials like this in order to predict stock prices because when we just treated the first 1,000 days as kind of training data in order to fit our polynomial, and then left out the remaining 100 or 200 or so days in order to see like kind of which polynomial fit the line best. The 10th degree polynomial picks up on this little downward trend at the end and assumes that the stock price is going to dip towards negative infinity, whereas all the first, second, and third degree polynomials actually fit the data better and would have given a better prediction or extrapolation of what the actual price of SoFi stock would be. Yeah, so now McLean.
Yeah, so now I'm gonna go over a couple more ways that you can use not using things that we talked about in numerical analysis. So this is called the exponential moving average, better known as the EMA. The formula is this formula that I have written up here. It is the alpha times P plus the 1 minus alpha times the previous EMA, that EMA T minus 1. So how this is used is this is kind of looking at the current price and then giving a estimate prediction for what the price will be in the future. These candlesticks that you see here are all 1 day candlesticks. And how this is used a lot of times is traders will like to wait for either a break of the EMA price or like if you see here, one candlestick above the EMA will signify a general upwards trend in price, and then they will enter a position there. And usually they would like to wait for a clear break below the EMA line, and that will signify a downward trend in the stock. And then so the EMA is used for more of like a long-term trading. And so what I have here is called VWAP or volume weighted average price. This is going to be more of like your day trading strategy. So basically what VWAP is kind of a leveraged price prediction weighted on the volume during that time period. So these candlesticks here are all 1 minute time frames. And so what this will do is it'll take the volume to multiply it by the price, sum that together, and then it will divide by the volume. And this will kind of indicate like a daily downward or upward trend. And how this is used oftentimes is like a break in the average VWAP will signify a downward trend during that day. As you can see here, you have three VWAP lines. You have a average VWAP, a higher and a lower limit. And so a lot of times when a stock goes down during a day, it will stay below this average VWAP line. And so that'll kind of just signify an average downward trend during that day.
So in conclusion, we're able to analyze a stock over a given period of time to determine some trends and patterns. Um, Linear, as we predicted in the beginning, is good for short periods that are just trying to indicate an upward or downward trend. Quadratic is good for the medium periods with medium fluctuation. It does a very good job of showing peaks and troughs. Both data models are good, but if you were to have data that goes past that 4 yearish mark, it would start to struggle a little bit more. So we would recommend using a more advanced model because you saw what happened when we tried using a 10th polynomial, completely overfitted the line and gave a pretty bad estimation. Um, so yeah. And then here's our references. Same one as before, just using Kaggle for our historic data.